Hey everyone, my name is Sherman, a CPA here at Life Accounting, where we help you save on taxes and increase your wealth. Today, I'm going to help you do this by explaining how you can lower your taxable income by taking the 20% QBI tax deduction, which stands for Qualified Business Income. If you are eligible for this tax deduction, then it will allow you to deduct up to 20% of your business income, which can save you thousands of dollars in taxes. I am going to summarize all of the major details in this brief video so you don't have to spend hours of your time trying to figure out how this deduction may apply to you, which can save you some big money here. So go ahead and help me out by giving this video a thumbs up. And if you don't want to miss out on more videos and ways to save on taxes, then be sure to subscribe to our channel. Now, the tax deduction is available to owners of sole proprietorships, partnerships, LLCs, and S corporations. The deduction allows you to deduct up to 20% of your qualified business income. Now, the key word here is qualified, and there is a lot of confusion on what type of business income actually qualifies for this tax deduction, so much so that many eligible taxpayers don't even take it because they think they are not eligible for it when they really are. So let's go ahead and look at it. So according to the tax law, qualifying business income is income from a qualified trade or business plus 20% of any qualified REIT dividends and qualified publicly traded partnership income. Okay then, well, what is a qualified trade or business then? A qualified trade or business is a business that is not a specified service trade or business, or a business where you perform services as an employee. Okay, so with that said, the next question is, well, what is a specified service trade or business? And does this mean that any business that performs services cannot take this deduction? Let's see. The instructions for taking this deduction say that services performed as an employee are excluded from qualifying trades or businesses. When I first read this, I thought it meant that you could not take this deduction if your business has employees that perform services. But then when I reread it, 3 words stuck out to me: as an employee. So if I perform services as an employee, I cannot take the deduction. But I don't necessarily get the impression that if other employees provide services and I do not, that I cannot take the deduction. For those CPAs and accountants that follow our channel, go ahead and comment below and let me know what your take is on this. All right, now let's move on to the whole specified service trade or business thing. Now, as we mentioned earlier, these type of businesses are excluded from qualified business income, which includes, by the way, any trade or business in the fields of health, law, accounting, consulting, financial services, and other service-based businesses, as you can see here. But hold on, wait a minute. There are exceptions to this. In a later instructions manual, the IRS provided several exceptions to what they call specialized service trade businesses. So let's back up real fast to make sure you understand this. SSTBs, service-based businesses, are excluded from the QBI deduction. They cannot take it. But there are exceptions to those who are excluded, meaning that if you fit the exception, you can still take the deduction as a service-based business. Let's look at a couple of examples here. So health businesses like physicians and other healthcare professionals are specialized service-based businesses. However, it excludes services that are not related to medical services, like the operation of health clubs or spas, or the sale of pharmaceuticals or medical devices. And here's another big one: consulting, meaning people who provide professional advice or counsel, is technically a specified service trade business. However, the instructions excludes the performance of services other than advice or counsel, such as sales, and even look at this, training and educational courses. It also excludes consulting services that are embedded in the activities that are not a part of a specialized service trade business. And these are just 2 examples of exclusions, but there are many more. So the bottom line here is that you can take this deduction if you are not a specialized service trade business and you do not perform services yourself as an employee. However, if you think you are a specialized service trade business, before you assume that you cannot take this deduction and miss out on thousands of dollars in tax savings, please read the fine print to see if there are any exclusions that may apply to your business. There's even a flow chart in the instruction manual to help you determine if you are eligible for this or not. And getting this right could put more money in your pockets. Okay, now let's talk about how to determine the amount of money that you will be able to deduct and what tax form you will need to complete to take full advantage of these tax savings. By the way, if you're enjoying this video, be sure to like it and drop a comment for me below. All right, so how much money can you deduct for QBI? It's really quite simple. You would just take all of the qualified trade or business income that you have and then take the lesser of the following two amounts. Either A, 20% of the qualified business income that you have, or B, if you take wages from your business, then you would take the greater of 50% of the W-2 wages that you took from the business, or if you have property, you would only take 25% of the W-2 wages plus 2.5% of the unadjusted basis after acquiring that qualified property. Now, more than likely, you will be taking 20% of the qualified business income, as most pass-through entities do not take any W-2 wages from their business. It actually doesn't make any sense to take W-2 wages from your business unless you are an S corporation, which is required to take a reasonable compensation from the business. All other businesses can just take distributions or dividends from the business. Now, for you high earners out there, it is important for you to note that the amount that you can deduct can be phased out if you earn too much income. In fact, if you earn too much income, you may not be able to take this deduction at all. But stay tuned until the end because I have a quick strategy to get around this. So let's take a look at the income thresholds here. According to NerdWallet, the income threshold in 2021 will be about $165,000 if you file as single and about $330,000 if you file jointly with your spouse. Now, if you earn above this threshold, it does not exactly mean you cannot take the deduction. According to the tax law, if your income does not exceed the threshold amount by more than $50,000 for single taxpayers or $100,000 for joint taxpayers, you can still take the QBI deduction. It's just that the amount of your deduction will phase out, meaning that you will only be able to take a reduced portion of that tax deduction. But what if you earn far above this amount? Well, here is a free tax strategy for you, since you made it to this point of the video, that many high earners use. Let's say your qualified business earns $500,000 in income. This means that even if you are married, you probably will not be able to take the QBI deduction because of the phase out. However, let's say that you created a separate corporation that just so happens to provide services to your company. And let's say that you paid that corporation $200,000 for the services that they provided to your company. Well, in this case, all of a sudden, you would now have a $200,000 expense that you paid to the corporation, and now you can take this as a tax deduction, therefore lowering your business income to $300,000. And now that your taxable income is within the threshold, you can also save thousands more by taking the 20% QBI deduction. So that's a quick tax hack for making it to this point of the video. Now, in order to claim this tax deduction on your tax return, you would need to complete Form 8995 on your tax return. And if you need help with doing that, be sure to subscribe to our channel. And if you want more videos on this topic, let me know in the comments below. I will see you in the next episode here.